So hello everybody and welcome to today's special presentation. I'm Terry Ryder, founder of Hotspotting, and my guest presenter today is one of Australia's leading property investment experts. Jason Paetow is the Managing Director of AllianceCorp. One of the most fundamental mistakes that property investors make is that they too often begin the process of seeking to buy an investment property by focusing on location. Whenever I'm involved in any kind of formal presentation when it comes to question time, 90% of the questions are about location. Now, while people's interest in the best locations to buy is understandable, the problem is that it means many people are starting in the wrong place. They're thinking about the what and the where of property investment before they've considered the far more important questions, the why and the how. Too many people jump in without considering their goals, their end game, the strategy for achieving their objectives, and a whole lot more. So today, I'm delighted that Jason Paetow from AllianceCorp has suggested a topic called Beyond Locations, Investment Fundamentals for a Portfolio Grade Strategy. Now, I love that set of words because it introduces a subject that should be front and centre for all wannabe property investors before they start considering what they'll buy and where. So Jason Paetow, welcome.
Fantastic. Thank you for the introduction, Terry. Really excited to be on your webinar today. Really looking forward to it. Now, I'm conscious of the fact that we've only got approximately an hour and we want to allow some time for people to ask questions at the end. So I have put some slides together. But look, Terry, this is a subject that I'm very passionate about. Look, I started the business approximately 12 years ago, focusing more on helping home buyers and investors buy established properties here in Melbourne. My passion, though, was always the helping investors and the wealth creation side of things. Look, you know, where I love to be in the office is standing right there by the whiteboard in front of my clients, showing them how their finance works. Because when you think about people wanting to build wealth, you know, some of their biggest concerns they have are around, you know, how can I afford to do this? You know, how can I manage my cash flows? This is going to impact my lifestyle. So really teaching them how the finance works really sort of opens their eyes up to the possibility. Now, unfortunately, though, while a lot of people understand that at the end of the day they need to go to the bank to get the money, they're often more focused on the location. It's something that they tend to think about first. And I wish I had $1 for every client that walked through the door and said, Jace, I'm going to use your services. I'm going to use you as a buyer's advocate because you're going to tell me where the best location is. And look, you know, if we want to have a look at locations across the country, we're on St Kilda Road here in Melbourne. CBD, you've got Albert Park just on the other side of Albert Park Lake on the beach on Port Phillip Bay there. You know, one of the best performing suburbs, but the majority of Australians can't purchase there. It's incredibly expensive and the rental yields are so low that even if you could buy one, you're probably not going to be in a position to buy your second too soon. So really what we try to really educate clients on is that, yes, absolutely location is important. Look, I've got your location reports here, your hotspotting reports, they're never too far away. We rely on them heavily as you being a member of our panel, and we thank you for your team and the research that you put together and giving us those insights. But before we start to think about that, we really got to understand, well, hang on, why are we doing this? Okay, why are we researching locations? Why are we wanting to buy a property? And we've got to think about the longer term goals. And when you start to think about that, then you start to realize that if I do want to achieve some significant financial goals out of this exercise of investing in property, what do I need to achieve that in terms of my portfolio? Because one property is just not going to cut it. 95% of investors out there, Terry, as you know, only own one or two investment properties. Yeah. And the vast majority of those get stuck on one or two because of the finance. Either the banks are not going to lend them any more money, or they're concerned about the cash flows, they're concerned about negative cash flows, things of this nature. So if we can really encourage and educate people around how to finance and give them more confidence, well, then that will give them more confidence to go out and make the better decisions when it comes to selecting the right types of properties that suit their personal circumstances. So as I say to everyone, Terry, no one can recommend a good investment property without really understanding the client's goals, what they're trying to achieve, over what timelines, and what their borrowing capacity is, etc. So I guess that's what you and I are going to touch on today, more about some of those decisions, some of the strategy that should take place before you start thinking about locations, because it's that strategy that then will guide you in terms of the types of locations and types of properties you should be considering for your portfolio.
Yeah. All right.
So what I might do is I might just share my screen, Terry.
Okay.
So let's have a look. Okay, so
Wonderful.
on the screen, as you know, we're talking about beyond low locations. So, so just quickly, what we're going to have a look at is what comes before locations. We're going to have a look at a case study too, Terry. So I find the best way to explain some of these strategies and scenarios is through a live case study. So we'll have a look at how that is sort of impacted one of the clients. We're going to discuss the portfolio grade strategy, which is all about making decisions with regards to locations and types of properties in terms of building a portfolio. And then we can touch on those locations a little bit more. So what are some of the considerations? Now, obviously goal setting, like I touched on, why are you doing this? What are you trying to achieve? Is it a passive income? Okay, well, how much and over what time frame? Or are you simply looking to pay down the mortgage quicker? Or, you know, are you close to retirement? What does the strategy look like there? You simply want a better lifestyle. You want to go on more holidays. So I won't spend too much time on that, but it's really important to identify that, write it down, talk to your partner about that. You really need to understand how your borrowing capacity works, because at the end of the day, when investors buy money, they're generally only putting in anywhere between 10 to 15% of their own funds, and the balance of the funds are coming from the bank. So it's the banks that primarily are funding these purchases. So we need to understand how they work. We've got to find a way to manage those cash flows, and that comes with the financial structuring. And then from there, once we understand all those areas, it's usually the strategy that then will determine, well, okay, these are the price points, these are the sorts of yields we're after, and then where can we go to get the best capital gains over time. So we call this process what we refer to as the portfolio grade strategy. So again, reminding clients that you're not going to achieve significant wealth by just owning one property. Normally that comes from finding a way to grow a portfolio of properties over time. So the first thing we look at, as we discussed, have a look at the financial goals and then consider the exit strategy. So, you know, for someone that's very close to retirement, that's a very different strategy from say, a young professional couple who are just starting their portfolio, which means that they could be purchasing in very different locations that deliver very different outcomes and very different types of properties, whether it's new, established, off the plan, cash flow positive, heavily negatively geared, whatever the case may be. Then we take into consideration the finance strategy. All right, and this is all about having a closer look at the client's personal circumstances and that of a bank and that of the cash flows of the property, and I'll run through that in a minute. And then from there, as I said before, that's when we go, okay, now which locations can deliver these outcomes that are going to satisfy the finance strategy? Because if we don't focus on that outcome, we're going to struggle with the banks in terms of finance, potentially on the second or third property. It's only then that once we have the finance strategy, we got an idea of the locations and the types of properties, that then we start on a local level, and also the property itself start to apply that more traditional investment criteria. Simple things like we want low vacancy rates. You know, is the property suitable for the rental market in the area? And then obviously looking at all the fundamentals that are going to be driving growth and limit on supply and all this sort of stuff. But unfortunately, Terry, what most people do, they focus on point number 4. So they really focus on, you know, what is the best sort of location, you know, what sort of property do I like, without first taking into consideration everything above the line. It's usually once they work out a location or type of property, then they might start talking to the bank, etc. All right. So really, the strategy has to be tailored to your goals and your financial circumstances. So the best way to sort of explain this process, or an example of this, is to look at a live case study. So this is a couple of clients of ours, Greg and Steve. They approached us last year, and they were interested in buying a property. So young guys, they're really keen. They've done a bit of research. They really want to go places, and they realise that buying an investment property is the best path for them. Now, when they came to us, Terry, originally, because they live in the southeast suburbs in a place called Ringwood, they had looked at the local property market, and they'd realised with the price points, they're probably not going to get into a property for much less than, say, 600,000 to 700,000. They weren't interested in buying an apartment. They wanted something with a little bit of land content. And between them, they worked out that based on their income, etc., that it probably wasn't possible. So they were going to combine their deposits to buy a property together. Okay. They also wanted to build a portfolio as quickly as possible. They thought maybe doing it together might help them do that, etc. They only had half the deposit. They worked out that they needed about 150,000. Okay, so that was their strategy. Here's an example of something that they may have been able to purchase there in the southeast. You know, the Ringwood location that was done incredibly well. My mother lives there. There's a huge amount of infrastructure with the freeways, the Ringwood shopping centres, etc. that have gone in there over the years and really pushed up those prices. So great location. But if we have a look at a 3-bedroom villa there at a price point of around the 720, if you look at their deposits, the stamp duties are horrendous here in Melbourne, 5% on the purchase price. Needed a little bit of work, so they could put some funds into that, but the rental yields are very low. So even though it's still a unit, it's still very low because of the growth that they've had in that region. You're looking at 3%, about $450 a week. If we run that through a PIA report to look at all the cash flows, and nobody should be buying properties without doing some cash flow analysis, etc. It had negative cash flows of about $59 a week. And we sort of run that at about 3.5% interest. I know it's a little bit less at the moment, but we're not going to have record low interest rates forever. So what we then show them is we said, guys, look, that's okay. And I understand your methodology for wanting to do that and to get into the location and pull your funds together. But the immediate concern I had with that when you do joint ventures is it does create restrictions for people who then want to buy properties in the future in their own name. Because if the boys do decide to then go buy another investment property in their own right or buy a home at some point, they're going to get penalised because the banks will take into consideration the full debt on this property, but they'll only take in half the rent because there's 2 of them. So there are some disadvantages. So I'd recommend don't necessarily jump into do joint ventures with other people. You've got to really think it through, because if you do decide to go your separate ways in the past, owning the one property, the banks will penalise you in terms of finance. So what we showed the guys is, guys, before you do anything, understand how finance works, right? So I've raised one concern. The next thing you need to understand is that if you were to buy this on your own, I can see through the calculator I've put on the screen that you wouldn't be able to do it on your own. And I guess that's the reason why you're doing it. So the first thing we have a look at is we've got to understand how banks lend money, all right? There's income coming in, there's expenses. They look at cash flows. Anyone can access these calculators online. There's no field there for how much cash you got or how much equity it's got. It's just cash flows in and out. Because the boys are still quite young, they're not on a significant income and they've got small savings. To do it on their own, they only would have had a borrowing capacity of around the 500,000, right? So that's why they're suggesting that they do it together. If by doing it together, and when I put their figures in, they do have enough borrowing capacity, because the property has negative cash flows, even if they went to do another one together themselves, they would still struggle because of the negative cash flows with regards to the property. So before anyone buys a property, you need to play around with the calculators, because depending on the type of property, if it's a high yielding property and the rental yields are high, your borrowing capacity is up. If it's a lower yielding property, and it could be lower yielding because it's experienced some good growth in the past, it's going to bring your borrowing capacity down. Your borrowing capacity, as a general rule, you don't want it dropping much below, say, 400,000 or 500,000, because once it does, well, where are you going to get good quality properties for that price point? You've always got to maintain that borrowing capacity. So my point I was trying to make with the boys is that never buy a property, even if you've got approval to do it, without then considering how that purchase impacts the next property. So I would always say to the boys, look, if whatever you're planning to buy, run a scenario on how that purchase impacts the next property in terms of getting finance, because you might find it's the wrong type of property for you. Because when banks look at how much they're prepared to lend you, as I mentioned before in the calculator, it's on your personal circumstances, how much income you have, what are your expenses, what are your liabilities, do you have big credit cards, do you have lots of kids? But it's also the bank then attaches the cash flows on the property. Right, so this is an example of a couple who wanted to buy some properties locally because they were comfortable. They lived in a major capital city. Most properties in major capital cities in the established areas have negative cash flows. It's just the reality of the situation. And as you can see here from the diagram, although they started out with strong borrowing capacity, over time they bought a couple of negative cash flow properties, and it dropped their borrowing capacity so low, like the 95% of investors out there, and they sort of got stuck. So once you get stuck, it's very hard to reverse it, unless, of course, you're in a situation where you've got massive pay rises on the horizon, or maybe you're in a position where you might have an inheritance coming where you can pay down all your personal debt and really get your borrowing capacity back up again. But that's what tends to happen. A lot of people get stuck without actually knowing that they're going to get stuck. It's sort of too late. We've had some clients that have had to reverse some of their purchases or go put their properties back on the market and then restart the process again. So to give an example, if a client came to us and As you can see on the left-hand side of the screen, this represents your borrowing capacity, and their borrowing capacity wasn't huge. Well, then we might suggest to them, well, look, if you want to look at something that has negative cash flows on this particular purchase, or it might be in an area that's close to you, that's fine. But understand this is what it will do to your borrowing capacity in preparation for the next purchase. So what we try to do is we try to balance out the properties to also protect or support their borrowing capacity as much as possible. We don't want someone that doesn't have a great borrowing capacity to send it through the floor because they're going to get stuck. So you can manipulate your borrowing capacity with the types of properties. If you buy a property that has very high yields or significant cash flows, you can get it up. Now, the opportunity cost, obviously, with some of those strategies, you've got to be mindful of what capital growth that you've experienced historically, and what does that capital growth look like in the future? Because as a general rule, high yields often come with less or more moderate growth. But at the end of the day, you've got to find that balance between getting the capital growth, but also supporting your finance strategy. Because you could do all the best research in the world, Terry, and you may have picked a great location, and you might look at that property and go, wow, it jumped up $100,000. The bank will have no issue giving me more money for the next purchase. But again, you go to the bank, and the bank, as I showed you from the calculator, they don't care how much the property grew in value. They don't measure your borrowing capacity as per the calculator that I showed you. There's no field there for how much equity you got. So even though you might have a good property that's got good growth, it doesn't mean to say the bank's going to give you finance. The bank's only looking at cash flow. They're not looking at growth. So this is frustrating because some people invest in those locations, go, I'm doing really well and I want to get another one, but I just can't unless there's a significant change. However, by choosing certain types of properties, you can manipulate that borrowing capacity over time. So that's super important. The other thing we looked at with the guys is we said, look, the property that you want to purchase in Ringwood in Villa is what we call a high cost strategy. There's also strategies that we refer to as a low cost. So a high cost strategy might be that you are looking to purchase in the inner suburbs of a major capital city. Because of that, the properties obviously come at a much higher price point. An example there of buying an established property at say 800,000. If you're here in Melbourne and you're doing a 90% lend, you can put down your 10% deposit, but then you're going to get hit with stamp duty of about 40,000. If it's an older property, you might have to add some value to it, etc. So you can see there, similar to the villa that the boys were looking at, you need a considerable amount of funds. In this example, as much as 170,000. Now, if it is an older property, although it may have had some pretty good capital growth over time, the rental yields might be low because capital growth does this, but rental yields don't increase at the same rate as growth. So that's why you get these, you get this discrepancy there. So some rental yields can be as low as 2%. That really impacts your cash flows. So something like that property on the left there might cost you $150 a week. Now, again, for a high income earner, that might not be much of a problem there because we're focusing on that capital growth. But someone who hasn't got a strong borrowing capacity, that's gonna be a real problem. So we suggested to the guys that they might want to look at more of a low cost, what we call a low cost strategy. We might target something that's new or off the plan. Look, we're not big fans. We're not advocates for apartments in high rises and all that sort of stuff. If it is new, maybe a townhouse or some sort of house and land package or dual income, dual lock, something along those lines. But at a price point of say 500,000, where you're putting in a small deposit, and you can also lower your stamp duties and your costs, etc. So this is again more suitable for clients that don't have a lot of accessible cash or equity. Something like this strategy can work well because again, with the higher rental yields, etc., it's going to support their borrowing capacity. So it's all about, okay, which property is going to help you get into the second property quicker, and the third property, and so on, and really be focusing on not just what's in front of you in terms of the transaction, but what you can do in terms of building a portfolio over the short term. So that is super important. So then we came back to the guys and made some suggestions that if we look at where their borrowing capacity is, and it wasn't massive, if we look at the fact that between them, they only had approximately 70,000. So still a lot of savings that would need to happen in terms of getting that villa unit. And we have a look at their goal, and again, like everyone, is to how quickly can I build this portfolio? How quickly can I achieve some of these financial goals of mine? So what we suggested that they do is we look at some regional areas, and I know that Terry, you're a big advocate for a lot of the regional areas as well. We monitor a lot of your reports. You and I are very much in agreement. Where historically, when I started the business, I was a real snob. I bought in the inner suburbs of Melbourne, like literally 10 kilometres in the southeast. I wouldn't go anywhere else because we didn't need to, Terry. You know, as you know, the properties were half the price. The rental yields were still quite high. Back then, everyone could get low doc loans. You didn't have to prove your income. You didn't have to do any of that. You just signed a piece of paper. It was just crazy. And, you know, people were doing incredibly well. But like my business and a lot of my clients, over the time, the property prices kept going up and the rental yields as a percentage started to fall away a little bit. And my clients were having struggles buying into those areas. So we had to go further out. So we went out to the middle suburbs. Then we went out to the outer suburbs. Then we started doing all the regional areas. And right now we look at all types of properties. So we'll buy established, we'll buy new, we'll buy off the plan, because everyone's circumstances are quite unique. And depending on what stage they're at in terms of their portfolio, they'll need different outcomes. So Ballarat was a region that we're a big fan of. It's still commutable. I actually had a staff member that lived in Ballarat and still commuted to work. You know, it was a big regional centre. We generally like regional centres with at least 100,000 people or more. We'd like to see some diversity there in the economy, etc. And really, it was about that ripple effect that was taking place in that we'd had a surge of activity in the Melbourne market, and now that was pushing a lot of people into these out areas. Again, Geelong's another one that did incredibly well for the clients over the last few years. The boys, what we did here was show them that with something like this, they don't have to purchase together. And we generally recommend as a rule, you try to keep it separate if you can, because as I mentioned before, it can get messy. It can get messy with the banks, particularly if you want to go do your own thing and all this sort of stuff. So both those boys were given the opportunity, among other locations, so we always give options, to consider this area. And we give them all the research in advance. A lot of that research is your reports also, Terry, and they do their own due diligence. So we teach them how to research markets. And it's part of the expectation that, yes, we can do all the heavy lifting, but you also need to do your own research and be very comfortable with these locations, etc. And with this option, 4-bedroom, brand new home, they paid very little stamp duty. I think it was about $8,000 or $9,000 because they only paid on the land component before they put the house on it. Very strong, very low vacancy rates in the area. The rental yields are quite strong, close to 5%. And, you know, with the cash flow positive income that they're able to generate about $140 a week, that's significant to someone in their early 20s, okay? With the view that also that cash flow positive income, the primary reason behind targeting this property is, one, because we knew it would help support further lending when they're ready to get their next one. But number two, that market was surging. So when we target some of these housing estates, we tend to focus the areas where the estates are surging. But as I mentioned before, we also buy established properties in Ballarat for other reasons as well. So those boys purchased that property now settled sort of during COVID. It was quite funny that during COVID, some of these areas, the land values actually went up in value because it's all new homes. So the government put out the $25,000 grant, and all of a sudden there was a flurry of activity. It was opposite to what people were expecting during COVID. In other areas, property prices are coming down, the land is going up in these areas. And they've had a recent valuations of $500,000 is the highest valuation that those guys now generate. So again, that's approximately $80,000 in equity very quickly within the space of roughly 12 months or so that those guys can now use, again, to help them go towards that second property. So again, a lot of figures on the screen now. I don't want to go through all the figures, but nobody should be buying property without running scenarios, using software to look at, well, okay, if the rental yields are this, what do the cash flows look like? If you just scroll to the very bottom there, the $142 cash flow there, that's what's representative of the positive cash flow. So that's after tax. Tax credits are quite significant, etc. Just because it's a new property, there's a lot of depreciation, etc. on it as well. But yeah, with those cash flows that they're able to achieve, that goes a long way in helping them towards the next property. So in terms of their second purchase, we had already planned what they were going to potentially look at doing for the second, because again, when we sit with the clients, it's not about, hey, okay, what are you going to buy for your first property? It's like, well, okay, if we buy this first one, what can you do for your second one? Potentially, what can you do for your third, and over what time frame? So we're able to map that out. We tend to talk to clients about portfolios of between sort of 5 to 10 years in advance, and we can sort of get an indication based on their borrowing capacity, things like, you know, what sort of pay rises do you think that might be possible in the future? Is there anything else financially happening? Is there any inheritances or anything like that in terms of helping you pay down the debt? We sort of factor in a lot of that stuff. And then obviously looking at what the banks are doing and forecasting interest rates, etc., to get a bit of an indication of what they can do. So with all the clients, there's an expectation that every year you do a portfolio review. All right, so has much changed over the last 12 months? Has your income gone up? Have you paid down personal debt? With the view that let's look at getting that second or third property. So the boys were super excited. We caught up with them recently, and they put a case study together for us. And these guys are happy to chat to anyone. So all of our clients that put case studies together, if anyone wants to talk to them, or there might be some young people out there that want to know more about this story, you let us know and you can speak to the boys. Before they came into their portfolio review, which was just recently, they're actually talking about, they're looking at Ballarat market still for established properties. And we said, guys, just hold on there for a second. Like generally, as a general rule, diversification is important. Okay, you've already got a property there in Ballarat. We're not buying a lot of house and land packages in there at the moment. We think that there's been a bit of a surge in activity now, which is starting to fall away a little bit, but certainly established properties we're still buying there. But you might want to consider some other locations. You might want to consider buying interstate. You've got to take the emotion out of it. I know you've done very well there in a short space of time, but let's look at some other up and coming regions. And that's why we sort of talked to them about Brisbane. So with the two options there on your screen, based on their price point at the moment and their borrowing capacity, we're again looking at a purchase price of somewhere around that sort of 400. And a couple of options there is we're looking in some of the northern suburbs there, in a place called Burpengary, again, something established to give the portfolio some diversification. Some of the immediate benefits there is it's a very affordable, it's in an established area, it's close to infrastructure, transport, things like that. It's just north of Brisbane and the rental yields are quite high. Jimboomba, just south of Queensland. We're looking at that location as well for them. That's sort of similar to their first strategy in that it's a low-cost strategy, high rental yields, low vacancy rates. But there's a huge amount of infrastructure that's going into that particular region, particularly to support the population growth there in the newer states that are going in there as well. So we're looking at those two options. So the boys now are ready to get their second property. All right. Now, had they not come to see us, they probably would still be saving up for that first one or trying to get into that first one. Whereas now they're in a situation where they've both bought one each, they've got tenants in it, they've got super strong cash flows. They've both generated about $70,000 to $80,000 in equity already in those properties, which is then going to help them fund along with their savings, because the boys do save quite well, considering their ages and their income. Now they're ready to buy these. So we're out now researching these sorts of types of strategies for them in the Brisbane market. So they've got one in Victoria, they've got one in Brisbane. And again, these ones will be cash flow positive with the view that we can see in these areas, there's a lot of strong indicators that they're going to get some reasonably good capital growth. And now they've got two properties. So what a scenario for these boys, two young boys. They've gone from one property together to now being in a position where very shortly they're going to have two, and they're fully diversified, cash flow positive, and we've got strong fundamentals there for them to get ready to get into property number 3 a little bit further down the track. So I guess my point being is that I would just urge everyone is that while, yes, we're all fascinated with the next hotspot and we want the absolute best location, it's more than that, because as I said before, the best location is out my window here. It's Port Melbourne, but most people can't get into Port Melbourne, right? You just can't do it. We want to support a strategy, right, that's based on your goals. You know, where are you at? Are you just about to retire? Or are you starting out? Or what are you trying to achieve? Your current financial position, okay? And then also tie into that the type of property that you might buy in terms of how that impacts also your lending capacity, your borrowing capacity with the banks. Because let's face it, if you can't get the money to invest, well, then you can do all the research in the world and it's just pointless. The banks aren't going to lend you the money.
So, Jason, would it be fair to say that if Greg and Steve had stuck with that original strategy, they might jointly own one property at this point, but by adjusting the strategy with your guidance, they've actually ended up with a total of 4 properties between the two of them? Yeah,
absolutely. Absolutely. You know, look, it's quite common, particularly between siblings, to invest together, but they don't realise that had they bought that first property, and let's say, for example, one of the boys decided that they wanted to do something on their own, or they had a partner or whatever, when they go to the banks will say, well, look, you own this other property, yeah? And the boys will be like, yeah, we do, but we own it half and half. The bank will say, well, we don't care about that. We're gonna halve the rent. And my argument is, well, then you should be halving my debt. Well, the banks don't do that, right? They always want someone to cover the debt. So we're going to apply the full debt, because if your brother's no longer here, it's effectively your responsibility. But we're going to halve your rental income. So what they're actually ending up with when they put it into a calculator is the full debt, but only half the rent. Now that's going to really hurt your borrowing capacity when you go to buy that next property on your own, whether it's your home or an investment property, right? So it does create some issues. So by adjusting the strategy, by reducing the purchase price, by targeting properties with higher yields, by targeting properties with lower purchase costs, the boys now are effectively in a position where they've got 2 properties. Literally within the next month or 2, they'll have that second. And now they've got 2 properties increasing in value. They're going to have cash flow positive income. They might be generating $250 a week, call it, as much as $250 a week moving forward. The other reason we mentioned Brisbane to them is that the yields in Brisbane are higher than Victoria. The purchase prices are more affordable than buying in Victoria. The stamp duties are only 3% versus 5%. So it's not just one thing, it's looking at a whole range of different contributing factors to then develop these property wealth plans for the clients.
Okay. Could I just remind everybody watching and listening that if you've got questions, please type them into the chat box or the Q&A panel, either or. One's as good as the other, and we'll try to deal with as many of your questions as we can in the time that we have available today. Back to you, Jason.
Absolutely. So then that sort of leads on to then having more of a location chat with a lot of the clients over time. So you can see on my screen here, I've just picked a few locations there. I'm not going to go through in too much detail. There's quite a bit of data there, but just very quickly, some of the regions around Victoria, for example, I've got Melton there, Hume City, Mornington. When we look at some of those areas, yes, we're identifying those drivers, those key benefits. For example, in Melton, what's happening in Melton? What infrastructure is taking place? What does the population look like? What is demand? What is supply? We're looking at the types of properties. What types of properties are common in those areas? You're looking at, is it more new properties, house and land package? What about the established market? What does that look like? What are the cash flows? What are the yields? And then what it really comes down to is then, okay, who is this suitable for? Who is this location suitable in terms of the type of client that we're dealing with? So then it comes back to, well, what does their property wealth plan indicate to us? Is this a client that needs a property at low price points? Is this a client that's got plenty of funds, plenty of available equity and high income? Because that will be a very different strategy to someone on a low income, a small amount of cash, a small amount of equity to work with. What's the client trying to achieve? If they're close to retirement and they've already got quite a few existing properties and they're really chasing yields, okay, well then we really need to target properties with high yields. But then do we look at established or new? Because there are some advantages with new, but then once the client retires, they won't get those tax credits anymore. So therefore, what do the cash flows look like on that portfolio? All right, so that's how we work our property wealth plans. we first work out what does the client need in order to continue to borrow from the bank, but also generate the sort of types of returns to achieve those goals in order to build a portfolio. Then we go and find the location. So we actually work in reverse. We start with the suitability column there, and then go, okay, this is what the client needs. And then we start to work our way across to identify those areas that can provide those types of properties and those types of returns that the client requires for their portfolio. So, you know, we do a lot in Melbourne City, just in the eastern suburbs of Melbourne, the northeastern suburbs. Same with Hugh, which is in our northern pocket. A lot of established buying now down through the Mornington Peninsula, just due to price point, etc. Look, we do buy in the inner suburbs of Melbourne, but now you're looking at $1 million plus for some of those clients. Most clients that we deal with, which is sort of more middle income Australia, most price points across Australia will sort of average anywhere as low as 400 up to about 700 as a general rule. I don't believe that you need to be spending $1 million plus on investment properties. The rental yields can fall away, etc. But also you're not diversifying. Sometimes it's a better strategy to maybe buy two $500,000 or $600,000 properties versus one property at $1 or $1.2 million, and really chase the markets nationally. So it's the same with Queensland. You know, again, Terry, you talk about these locations a lot, the Moreton Bay region. You know, in terms of a lot of infrastructure, the proximity to the airport, employment hubs, stuff like that. Yeah. The price points there are still quite affordable for a lot of people, and especially established properties. You can still get into that market at low 400s buying established properties. And then again, you've got Logan down the south and Redland down to the southeast, which again has close proximity to Brisbane. It's a little bit more upmarket, but again, you know, a price point in around the sort of 500,000 or 600,000 can get you in those areas. Some of the townhouses can get you in a lot lower. So we rely heavily on the data and your team put together, Terry. We've obviously got our own team as well. But in terms of the portfolio grade strategy, that's what it's really all about. It's about understanding finance first. Then once you know what type of property, how much you spend, what years, then you start to research what locations can deliver on that outcome. So we got any questions, Terry?
Look, just one that's in my mind is the reason why so many people, I mean, the stats show that 75% of Australians who own an investment property own just one or two. It's something that you alluded to at the beginning. Is the main reason why there is this whole cash flow situation, which impacts on their borrowing capacity. Is that why most people get stuck with just one or two properties?
Well, most of our investors, Terry, live in our major capital cities, because obviously that's where our population lies. And so for most people, when they're thinking about buying a property, particularly when they get started, they generally want to invest in their local area. Majority of investors won't jump to purchasing interstate or necessarily a regional area because they're just not familiar with that location. So because of this, particularly historically, most of those properties are in established areas. And those rental yields are quite low, which impacts their borrowing capacity. But when they go to the bank's just putting an application form in front of you. The bank's not saying to you, hang on a minute, we've run some figures here and we just need to let you know that if you purchase this type of property, due to the cash flows on this property, it is going to actually impact your ability to get a second. You might want to reconsider, or it depends on whether you're just happy to buy one property. That's not a discussion that's had. That's why generally when we recommend finance specialists, we generally recommend brokers that specialize in helping investors rather than walking into your bank, because a broker who specializes in investor finance understands this. They understand, how this impacts people's borrowing capacity, and can give some guidance to the investor as to, you might want to consider that, you might not know this, but this particular property will reduce your borrowing capacity to X. In order to get it back up again, either your income needs to go up, or you need a way of paying off a significant amount of your personal debt. What's the reality of that? The broker might come back and say, look, if you buy this property, you might not be ready. You might not be in a position to buy another property for another 5 years, all right, or possibly longer. Whereas if you maybe change the strategy, maybe target something with high yields, etc., you might be able to get into another property in the next 12 months or possibly 2 years. So super, super important. Now, look, and there's a whole webinar around cash flows and, you know, managing the cash flows, etc., to also give people confidence. But certainly people need to be aware of their borrowing capacity and how it's impacted through the types of properties that they choose.
Yeah. Is there a rule of thumb that you use to establish whether a property might be cash flow positive or neutral in terms of the rental yield? Now, if you're borrowing around 2%, do you need 4% and above, or is it 4.5%? Is there a rule of thumb that you can apply generally?
Yeah, look, generally any sort of yields that start pushing close to 4% plus gives you a bit of an indication whether they're going to be more neutral. Now, when we talk about cash flows, though, there's the negative gearing side of things, and then there's the cash flow side of things. So most properties that we purchase right across the country, even with properties with high yields, tend to have negative cash flows pre-tax credits. Yeah. But to find a property that, you know, is cash flow positive even before you get your tax credits is incredibly difficult to find, and often they're in locations where the capital growth has been relatively flat. So, you know, rentals in the area still increased with CPI index and demand, etc. But because capital growth has stayed relatively flat, that's why these yields are so high. And the reality is that when we buy a property, we want a combination of both. We want yields to be as high as possible to support borrowing, but we also need that capital growth. It's our wealth creation, but it's also our ability to generate additional deposits to buy more properties. So obviously interest rates have a massive part to play in that. You know, even a lot of properties that were heavily negatively geared with the higher interest rates, you know, as much as, you know, $150 to $200 a week in some of these inner locations, you know, are now neutrally geared because interest rates are record low. But investors need to be careful of that. You know, you've got to understand that while interest rates are still going to stay relatively low for a little while now, you need to be prepared for the fact that they're at record levels. And that's why that PIA report that I showed you is so important, because, hey, it's great during times like this of record low interest rates for a client to say, oh, these cash flows are so amazing, they're great. But hang on a minute, let's put an interest rate in there of now 4%. Let's put an interest rate in now of 5%. What does that do to your borrowing capacity? What does that do to your comfort levels of now having a property that was neutrally geared that's now negatively geared? You need to run through all these scenarios because the markets, they're always changing.
Jason, Tina's asking a question. It really, I guess, relates to the type of property and also the location of the property, in referencing the Redland Bay area that you spoke about. Is it better capital growth to buy an older house near the water or a newer house but further out from the water?
Yeah. Great question. And again, Gary, this comes back to the client's circumstances. So I wouldn't be able to answer that. Like, we can tell you from the point of view of what does the forecasted growth look like in that particular region. And I would argue that if you've got a house there close to the water in Redland Bay, you're going to do very well in terms of capital growth. But from a rental yield perspective, I would imagine the rental yields would be quite low. And is that going to be suitable for that particular client? The only sort of, generally a client that is in a position to take on a significantly higher purchase price with a much lower rental yield is a client that has considerable borrowing capacity. They're on very high incomes. They have plenty of available cash and equity to support the purchase. Because if you're not in that position, and even if you're able to just squeeze that purchase through the banks, I can tell you now, with a property with negative cash flows to that extent, will smash your borrowing capacity and not enable you to get your second property. So again, like yourself, Terry, AllianceCorp, we can talk about what this location might do over time. We can talk about what the properties will deliver in terms of cash flows. But as to whether it's a good strategy for you, I need to know what your income is. I need to know what your expenses are. I need to know what your financial goals are. What are you trying to achieve? I need to know all that stuff before I can make a recommendation. And that's why I say to clients, like, if there's anyone out there or any other, so-called property experts trying to flog a property and say, this is a fantastic investment property, et cetera, for you, well, how can you possibly make that statement without understanding all my personal circumstances, my goals, et cetera, because that's what will determine whether that property strategy is a great strategy for you.
So I'm always amazed at how many people ask a question and think that there's one right answer to that question, like where's the best place to buy? And I think the central theme of everything you've said today is that the answer depends on the individual and their circumstances and what they're trying to achieve. And I often think that if you ask the question, where's the best place to buy, and you had 6 different people in front of you, there could be 6 different answers, a different answer for each individual.
Absolutely, because what's the metric? Like when you say, when we try to break down the definition of best, what does that mean? Are you talking about what is the best location in terms of value for money? What is the best location in terms of forecasted capital growth? What is the best location in terms of rental yields? How do we sort of break that down? It's really what is the best locational property for your circumstances, for what you're trying to achieve? That has to be the question. Because if it was literally best location, best property type, well, we wouldn't even be talking about all these other locations or property types or price points. We would literally just be talking about, the one location. That's it, guys. That's the best. But it's not nearly as simple as that. The example of the young boys there, that villa purchase wasn't ideal for them. However, if they had to come to me and they were a young couple and they were on a very high income and they could save a lot, absolutely no problems, because it wouldn't have impacted their borrowing capacity too much, because their high income would have sustained their borrowing capacity. We're not as reliant on how that property and the cash flows affect their borrowing capacity, because it's more focused on their personal circumstances. And if they're on big incomes and they're saving, they can comfortably get into the next property, pull out a bit of equity to do that. So again, that strategy would have been fine for them.
Can I just reference the point you made about trying to find that balance between a good yield and therefore perhaps positive cash flow and getting growth? Would you agree that in the current circumstances and in recent years that it's you don't really have to make a choice between high growth and a high yield, because many of the locations that have been producing the best capital growth in recent years are also those smaller capital cities and those regional areas where the rental yields tend to be higher also?
Yeah, absolutely. Because we always talk to our clients, and when we look at their borrowing capacity and we do a scenario on the whiteboard, and I talk about negative cash flows, I talk about neutral, and I talk about cash flow positive. And as a general rule, historically, we have generally said that as a general rule, very high level, if a property has negative cash flows, often it can be an indication that it's in a high growth area, all right? Because our yields are a percentage of the value of the property. So if the property is going up and rental yields aren't growing at the same rate, this is where we tend to have a situation where yields can deteriorate, all right? So it's an indication of potentially a high-performing area or historically high-performing area. Then, of course, you've got cash flow positive, and we talk about the benefits of cash flow positive and how that affects the borrowing capacity and all the rest of it. And the first thing the client says, they say, great, go get me a property that has high cash flows, high yields, and high capital growth. Well, usually they don't exist, because you can't have, if you have both, normally what would happen is all the investors would flood into that area anyway and buy them all up, and they'd push the price up, and then all of a sudden we're back to a situation where you've got low rental yields again, because the price of the property has rocketed up and that yield has then fallen away in terms of a percentage. But as you said, Terry, yeah, it's a unique. I can't remember a time where almost you can throw a dart at the board of Australia and pretty much find a property market there that's actually improving.
Yeah, I think it's a very good point to make, though, isn't it, Jason? That I've used that terminology myself recently a lot. It feels like you can throw a dart at a map of Australia and buy anywhere, and you'll get growth in the next year. But it's very important to think beyond this current boom phase we're in. What about, is the growth going to be sustainable in the long term? Are you going to continue to get growth to create the equity to help you build your portfolio? Therefore, you do need to be very selective about where you buy, having done those earlier steps about establishing the strategy.
Absolutely. And that's why the data that you guys put together is so important. Like, I have clients that come to me sometimes and, they do a little bit of research online, and I ask the question, what sort of research have you really done? What have you invested in your research? And they go, what do you mean, Jason? What do you mean by invested? I go, well, what sort of reports have you invested? There's plenty of them out there. You can buy a lot of reports out there. And they said, oh, we haven't really bought any. Well, why? You're looking at potentially building a multi-million-dollar property portfolio, but you can't pull out your wallet to spend a few $100s here and there to buy all this, get all this sort of data. It's absolutely critical. Like, when I first started as a buyer's advocate, although I was buying my own properties, I wanted to learn everything I can. And that's when I went off and did all my qualifications. I spent nearly $70,000 on my education over a few years early in my investing years. And every penny is worth it. You have to not just invest some time, but you also got to invest some dollars in getting access to this data. Now, a lot of viewers might say, I just don't have the time for that. Well, that's fine. That's why they've got groups like us, where we help you with a lot of the research. We teach you how to do research, but also too, all the reports that you provide, Terry, people should be subscribing to this stuff because it's invaluable. These are the biggest investments that you'll ever make. Invest some dollars in getting some good data there. That's super important.
I think what distinguishes the people who truly succeed with property investment from those who get ordinary results or poor results is a willingness to invest time and money before they invest the big money in actually buying the properties. And most people skimp on that. I find that they're willing to borrow money and spend $500,000 to buy a piece of real estate, but not to spend a relatively small sum of money on getting good advice, like from your company, or buying research such as from ours. And I think it's the worst kind of false economy when you're attempting property investment.
Yeah, absolutely. I have clients that come to me and they tell me about a holiday coming up, and they tell me about how much time they're spending on it and all the money they're spending on it, and going out and seeing all the travel agents and all this sort of stuff. Sometimes I ask, we send them out all this research because all of our clients, once we've put the property wealth plan together, we go and select different areas so the clients feel like they've got choice. They don't feel like we've just said, oh, look, this is the property. If a client's buying one property, we might send out 3 or 4 locations with 3 or 4 property options, and we send it roughly a week in advance so that they have time to do some research online. And look, I'm just surprised, some clients will come back and say, oh, I didn't get a chance to read through the report, but I'm happy to make a decision. Really? Like, you're about to spend $500,000 or $600,000 and you just, because you can't be bothered, because you feel like you're too busy, the decisions that you make today are going to impact you for at least the next 10 years. If you want to become a property investor, let's be real, you have to have a horizon of at least 10 years, not 12 months, not 5 years. You've got to allow that property to go through a full property cycle. We've got to allow it to mature. Only then, once you've allowed your property to go through a full cycle, can you really give get an idea of how this property has performed. So it's super, super important. But again, look, people are busy. I get it. I've got 3 kids myself. We're looking to have another one. I'm still pushing for the 4th. We run businesses. My wife's in the business as well. So to try and juggle and make it all work, I get that it's difficult, but I guess that's why it's so important that you take the time to reach out and watch webinars like this with Terry or myself, or come in for a session. So once we sort of wrap up today, Terry, I will give the viewers an opportunity to easily get access to a lot more information, because we've got a special offer for the viewers today, particularly for those that want to learn more.
And Nazara is asking a general question about your professional services and how it all works and what it might cost. Perhaps you could, just in very general terms, talk about that, or how people might follow up and sort of access what you can provide.
Absolutely, Terry. So look, we started the business 12 years ago. So I started investing when I was quite young and buying some properties when I was young. And then I went out and I was fascinated with finance. So I did all my finance qualifications, financial planning qualifications. I then became a licensed builder. I started doing developments, doing all that sort of stuff. But really the passion was always helping the investors. So in our business, head offices here in Melbourne, we've got offices across the country. We've got over 30 staff. We've got a dedicated acquisitions and research team. We have various components of our business. So the first area of our business is our educational arm. So this is our membership arm. This is where clients can become a member of AllianceCorp, and they can benefit from all the mentoring, the coaching, all the research that we provide across the country, putting together the strategies, putting together your finance strategies, putting together a long-term property wealth plan. So I'm not talking about just what you're going to buy next. I'm talking about what you can buy now and how that impacts buying your second, your third, your fourth. So it's a proper long-term property wealth plan. And then we oversee everything. So we do all the negotiations with builders, developers, real estate agents. We can help you buy in all the markets across Australia. We're licensed estate agents. We're fully transparent in everything we do and how we operate. You've got an option of different services, whether you want to buy established properties or new properties or off the plan properties. And it's a lifetime membership. So it's all about making sure that we educate you, get the foundations right in terms of you understanding the best strategies, and then starting that portfolio with the right types of properties, and then building on that, just like the brothers have through regular portfolio reviews. We also have a money coach. So we've got property coaches that do all the mentoring and help you build a portfolio. We have money coaches that help clients manage all their cash flows, budgeting, make sure they're managing the cash flows on the investment property and also their personal stuff, because all of this works towards the wealth creation and helping them get into more properties. And we also have an arm of the business where clients can invest in some developments or do armchair developments with us and the team. But really, it all starts with a complimentary consultation that we've put together. So these sessions are valued at about $500. They go for 90 minutes. This is where you can sit down with one of the property coaches, whether it's Zoom or in face-to-face, whatever you want to do. And this is where we'll look at your circumstances. So this is where we'll put a property wealth plan together for you, show you what you can do. If you like what you see and you understand and you can see the benefits of working with an organisation that's been doing this for a long time and have all the resources and the know-how to give you the confidence to fast-track your strategies, just like the boys have, well, then we'll invite you back for more sessions. And in those sessions, we continue to educate you, teach you about locations. We'll do all the research on the properties, send that to you in advance, teach you how to do some due diligence at home so you're super confident. And the beauty about the way in which we operate, Terry, is we're performance-based. So our clients have the opportunity to experience, our programs without committing to anything, all right? Because we're performance-based. That's how we operate. So we're all about just giving as much value. I'm sure there's plenty of clients out there that say, oh, this is great. I'll go see AllianceCorp and they're going to teach me all this stuff and they're going to give me all this education material. Like we've got libraries of videos and ebooks and all that sort of stuff. And I might try use that and I might try to do it myself. Well, good luck to you. That's my gift to you. If that's what you want to do, I have no issue with that. All I care about is you making the right decisions. Now, some of you will become a client out of it. Some of you won't, but at least you've got some education there from us to sort of help you with making some of the better decisions. Because, as I said before, you don't want to be part of the 95% of investors out there that get stuck on one or two properties.
So just want to remind people, if they want to take advantage of that exclusive strategy session offer, they can click on the link, which is now in the chat box. Everyone should see it in front of them. You can see the HTTPS /etc. link. You click on that, it will take you through to follow up on that special offer.
Yeah, absolutely, guys. Look, it's complimentary. Catch up with the team and look, getting good quality professional advice, guys, is super important. Like our guys are all experienced and qualified. Unfortunately, and Terry's familiar with this as well, whenever I see a bit of a boom, and I've been through a few of them now, all of a sudden I see all these new property investment companies I've never ever heard of before. And they can make some pretty wild claims about, I'll show you how to pay off your home in 5 years, or offering all sorts of things like, rental guarantees or incentives, or I'll pay you $10,000 or $20,000 to buy this property that we're presenting. You just got to be mindful of all that, guys. It's something that you experience from spruiker organisations, and you might not necessarily be getting the best advice. So you really want to work with a group that's proven themselves, they're performance-based, they're transparent in everything they do, they're licensed, and there's good quality education, and you can see the support is there. So anyone that joins us, if they want to talk to all the clients and talk to their experience, they have the phone numbers for that. They can go onto the website, they can see all the staff. I'm always nervous when there's a property investment group spruiking something and I go to their website and I can't see any staff profiles. I don't know who's behind the business. I don't know who the team is. all that sort of stuff. So it's something to be mindful of as well.
Okay. So we've just gone over the hour. It's probably time for us to think about wrapping it up, Jason. If people want to just follow up and make general contact, what's the best way to do that?
Yeah, so you can register there for a complimentary session. One of the team will reach out to you. We'll go through some questions over the phone with you just to ensure that you qualify, etc. But then also too, you can go to the website, alliancecorp.com.au. There's plenty of free guides there, guys. You can access videos, ebooks, stuff like that. So you might not be ready for a consultation, but you want to download more information, you can go to the website to do that, or you can simply give us a call or send us an email to info@AllianceCorp as well.
Okay. All right. Well, a good note on which to end today's session. Thank you, Jason Paetow from AllianceCorp, for a wonderful presentation. Lots of great information there. I found it personally interesting and informative. Just some takeaways for people who have been watching and listening today. To consider the impact of the first property that you buy may have on the second or the third ones that you may want to buy. That many people get stuck on borrowing capacity. The importance of cash flow and helping you to grow your portfolio, and the ability and to develop a balance between a high yield and high growth. And that's achievable with the right advice. I think the point was well made by Jason that you don't need to spend $1 million to get a good property and to get a good result and to grow your investment portfolio. And finally, the fundamental importance, which I stress time after time, being willing to invest some time and some money on good advice and good information if you want to succeed with property investment. That's it from me, Terry Ryder from Hotspotting. Thanks again to Jason Paetow from AllianceCorp, and thank you everybody today for watching and listening.
Thanks for having me, Terry. Thanks, guys.
Okay.